Mortgage rates are going up and startups should start preparing. Jerome Powell said himself it's going to be very difficult to have a soft landing in the economy, and mortgage rates are going up for housing. But how does that affect startups, and why should you care? Well, if you've been paying attention to the housing market like me, you know that some of the biggest housing bubbles in the nation are around tech cities. Obviously, you have San Francisco, Los Angeles, Seattle, and New York are all in these huge housing bubbles now with tech centers in there. But a lot of the other tech cities are booming in the housing market that you may not hear about as much in the news, but Phoenix, Denver, Atlanta, Salt Lake City, Austin, and Miami. All of these are cities with fast-growing tech hubs, and whatever seems to follow tech is expensive housing. These areas have some of the biggest housing bubbles in the nation, and of course with a housing bubble comes affordability issues. And for a long time, these high-tech salaries were based on that increased cost of living, the unaffordability of these houses. But things are changing quickly. Sales in Denver dropped 1.7% just month over month, and year over year, its largest drop in sales that Denver has ever seen on the housing market. And San Francisco is going up in flames. Not only is it a less attractive place to live because of the housing crisis, but San Francisco lost 7% of its population in 2021 alone. That's 7% of everyone that lives in the insanely expensive city of San Francisco, the capital of tech in the nation. So that's my thesis. These increasing mortgage rates will affect these tech cities. Obviously, they've created a housing bubble that will now burst, and that hurts startups, right? That's my theory. No, just kidding. Another thing that a lot of these cities have in common is unprofitable startups, and we are used to seeing these unprofitable startups on the stock market. This includes Uber, Lyft, Pinterest, Dropbox, and Zillow. But it's not just these heavyweight startup companies that struggle. It takes most startups 10 years to become profitable. Amazon itself took 14 years to find profitability. So there is a long period of time that these startups don't have enough money to run the business. So how do they get things going? Well, there are 4 ways that startups find the funding they need to run the business. Number 1 being bootstrapping. Obviously, you're starting a Series A startup. You're using your life savings. That could be only $30K to start the business. So everything is at a very slim cost. The bootstrap means that you might have to build your boot and strap it up because you can't afford to buy these pre-made systems. And this is most common in early startups in Series A or maybe B, but bootstrapping is definitely an early in the business thing you can do. The second way you can find funding for your business is through donations. That sounds like charity, but some of that includes government grants in 2021, I think even 2020 up until now. For some of these grants, the government has just created a ton of new grants. It was part of the stimulus for COVID back in 2021, and those grants are used to start new startups. But donations can come from people who are just fans of the technology and interested in seeing you personally create a business. But again, not a lot of startups can rely on these donations. It's definitely something you see more in a Series A, B startup or the seed level startup, but you're not seeing Uber and Lyft get a ton of donations. So another way that a company raises money and funds to get a business going is that they simply outsource the work. Now, that's not raising any money, but it's a great way to cut costs. You can outsource the marketing, the accounting, obviously the software development. Outsourcing is a great way to get the business growing and moving when you don't have a lot of capital. But finally, the most common way for these big startups to find the capital that they need to run the company before they finally reach profitability, that is through loans. These startups are getting loans, and it can sound like it is a charity thing when they call it funding, VC funding, but these are loans. And sometimes funding does involve these investors getting only equity, but most of the time it's based on loans. And what usually comes with a loan? Well, an interest rate. If we are in a market where we see the mortgage rates rising, that indicates a volatile environment. And how are interest rates determined? Well, it's determined on the market and the economy. So increasing mortgage rates on houses shows a volatile market. That means that people with money are not so willing to give it to those who don't have money because the chance of them getting back seems to be less. So if you see rising interest rates for mortgages as well as small business loans like you are seeing now, then you can expect that those interest rates will be rising for these unprofitable tech startup companies. Generally speaking, big tech companies are famous for burning through money. Listen to Musk himself saying that Tesla burns through money, and that's fairly common. It's hard to build organized systems when you are a fast growing company, but now that interest rates are going to be increasing for these loans, the cost of burning money increases. So in the past, it was really easy to give these high base compensation salary to candidates because the money had such low interest rates, what people like to call, it's like free money. But once the cost of this cash flow goes up with interest rates, companies are going to have to find ways to reduce companies are going to have to find ways to reduce their costs Companies are going to have to find a way to reduce costs, and in one of my last videos, like I had mentioned, the easiest way to reduce costs as a business is to lay off and fire employees. It's also to reduce employee salaries, but once a tech worker gets laid off, let's say they make between $120,000 to $180,000 base salary out in Austin, Texas. For several months now, it's been cheaper to rent than buy in Austin. So let's say we're renting in Austin for $2,000 a month in a 1-bedroom. Kick $2,000 off that monthly salary. That person is still looking at like 10 grand a month, and that money goes throughout the economy. It said that one tech employee can support the salary of 4 to 5 other service workers. So if you have one tech employee whose salary goes down by $20K, well, that's possibly one service worker that is no longer supported. Or if these people get fired and or laid off, then that's one less person that's able to support 4 other service people in the company. Rising interest rates for these startups and startup loans are going to affect everyone in the economy. Obviously, the tech employees, but the people who take the rent from the tech employees, the people who bag their groceries, who iron their shirts, who fix their shoes. There are so many people that are reliant on tech workers. Even these Airbnb owners are reliant on tech workers who want to work remote and travel. But now that the cost of burning money is going up, interest rates are going up, that means that startups are likely going to see more struggle in the future, or just generally slower growth. And that is my prediction. A lot of these big heavyweight companies that dominate the stock market, I think they are going to slow in growth for the next several months, up to 36 months. And it's not just obviously those big startups. I would expect to see, obviously, if you watch my layoff video, the Wonder Jaunt company went out of business completely, and I would expect to see a lot of other companies that may still be in that 1 to 5 or 1 to 10 year range where they can't really expect any profitability anytime soon. I think some of these companies may find it impossible to get the loans that they need to run the business. They may need to lay off mass amounts of people or go out of business too. So please check out this video in 6 months and let me know if I'm right. Subscribe to this channel so you can see my next upload, and let me know what you think in the comments below. Do you think that mortgage rates for homes are going to affect startups? And if so, are there other industries that are impacted by this that I may not have talked about? Thanks for watching my video, and I'll see you in the next one.